Today, we are very happy and honored to have Mr. Gan Head of Equities of HwangDBS Investment Management to be with us and share his view with us. So, Peng, can you tell us what is your investment philosophy and how you apply it across to all the funds that are under the HwangDBS umbrella?
Okay. Thanks for having me here. Let me share with you my investment philosophy and the company's investment style first. Okay. The key thing that we do is we manage funds on an absolute return basis. In simple terms, that basically means that we're trying to make money for our clients. Okay. We are not relative investors. We do not really benchmark. We just want to make absolute return through all market cycles. And we do this by creating a process where we buy into people running the business and we buy quality companies. That's our key focus.
Okay, when you mention absolute return, so practically, I presume that in a Malaysia perspective, it is practically a long-only way of managing the funds. Then in that context, I noticed that some of your funds actually are not really fully swing, can be from 0 to 100% in terms of equity. So on the other hand, you're managing the downside risk, right? When you're looking for absolute return. How do you manage this downside risk where you can't swing your exposure, right, all the way to reduce it to 0% in equity when the market is against you?
Okay, that's very true. Almost all the funds that we manage are long only. And what absolute return fund managers that are constrained by such a situation is what they normally do is they try to raise cash. Okay, our mandates are fairly flexible. We can raise cash to have downside protection. At the same time, we can also be long instruments offshore that hedges our positions. For example, we can long the VIX, we can long some of the reverse ETFs that actually goes up when the market goes down. So we can actually hedge our position to a certain extent.
Okay. Can you enlighten us of the funds under HwangDBS umbrella? How many funds are actually that are allowed to long on the reverse ETF, which is indirectly a shorting?
Okay. I think as long as the fund can invest offshore, this will be including like your HwangDBS Select Opportunity, HwangDBS Asia Quantum, and to a certain extent HwangDBS Select Dividend Fund. As long as you can invest offshore into Hong Kong or US, you can find those instruments where you can hedge your position.
Of course, when you are looking into a reverse ETF, you actually expose yourself to the currency side as well.
That's
so
right.
How do you manage the currency risk?
We have been going offshore for the better part of the last 4 or 5 years. We have a dedicated team that actually hedges the position. The lower the return mandate of the fund, for example the bond fund, the more hedges we put into place. Basically, we do not want to take currency hedges. So for example, in our Select Opportunity Fund, it can go offshore by 30%. Within the 30%, we have about 10% Hong Kong position, about 20% Sing position. We took the view that the Sing position has a natural strength against the ringgit, so we have not hedged it. But the Hong Kong position, because it's linked to US dollars, we have fully hedged the position. And the benefit of hedging, besides having no upside or downside risk on the currency, is that if you hedge to something like the Hong Kong dollars or US dollar, the counterparty actually pays you money for hedging. So there's a yield pickup from the hedging process.
Okay. So in that context, I mean, looking at the investment philosophy and looking at the current market environment, today, has the fund performance up to what you have expected, or you think that it's actually is much better than what you internally has budgeted?
Okay. Well, first of all, we don't really budget the return for the funds. We do have expectations for our absolute return clients of 8% per year. So far, the discretionary mandates that can go offshore, we have done about 10% year to date for up to May, which means we have actually exceeded our internal hurdle rate for this kind of absolute return funds.
Okay, so looking forward, for an investor, let's say of a moderate investor, and what are the funds that will be suitable for him from the HwangDBS umbrella if he's going to invest for, let's say, medium term, about 5 years?
Okay. I think for Malaysian investors, if they're based in Malaysia, if they have, most of them will have Malaysian property, Malaysian income, Malaysian wife, Malaysian salary, and so on and so forth. It's very obvious that you need to diversify yourself out of this country because Malaysia, after all, is an emerging market risk. So what we normally suggest is to buy into some component of offshore fund. And within the HwangDBS bracket, we have the Select Dividend Fund, the Select Optionally Fund, Asia Quantum Fund, to name a few. Okay. For investors which are more conservative, who expect more stable returns, and they can lower to medium risk tolerance, the best bet would be Select Dividend, which invests about 30% offshore and about 70% on Malaysia.
Okay, on the international market, currently, you are overweighting on which region and underweighting on which region?
Okay, the big call that we have recently is to progressively go overweight into China. Okay, China, as you are aware, has been flat as a market for the last year and a half. It has not performed at all, but it has also become one of the cheapest market in the region, cheaper than Malaysia, cheaper than Indonesia. In fact, it's the cheapest market in this region, which has not been seen for a long time. It's also got the highest growth. So this is one of the key markets we are overweight.
Okay. So looking forward, you still believe that China will still the one have the largest potential, especially for investors who have a longer holding period, and they should be confident with exposure in the China market?
Yes, I think that's our central belief. I think we have just recently gone overweight into China. Before that, we have minimum exposure. For the whole Asian and whole commodity cycle to be holding true, we need the China economic engine to come back alive. Currently, the government has been clamping down on the economic growth for the last year and a half. When they stop doing that, which we think is probably sometime end of this year or early next year, the economy can grow freely again and the stock market should take off again.
Okay, so thank you very much, Eng Peng, for enlightening us on how you manage your HwangDBS fund, and I think this will help the investor to make a better informed decision.
Thank you.